Ever wonder why oil prices seem to be on a roller coaster ride? The answer lies in the intricate dance between supply and demand, geopolitics, and global economic health. In the world of oil, it's a constant tug of war. On one side, we have factors pushing for higher prices. These include geopolitical tensions that can disrupt supply, natural disasters that can halt production, and economies recovering from the pandemic, thereby increasing demand. On the other side, we have elements pulling prices down. Think of a global shift towards renewable energy, technological advancements leading to efficient fuel use, and the potential for strategic reserves release. Now, let's dive into the heart of the matter, the conflicting signals about oil demand. These contradictions stem from two primary sources: economic forecasts and energy transition trends. Economic forecasts are a tricky business. They can swing between optimism and pessimism, influenced by a myriad of factors such as GDP growth rates, inflation, and employment levels. A robust economy typically means higher oil demand, and a sluggish one means the opposite. Then we have the energy transition trends. The world is undeniably moving towards greener, cleaner energy sources. This transition, while good for the planet, muddies the waters for oil demand projections. As electric vehicles become more popular and renewable energy technologies advance, the future of oil demand becomes increasingly uncertain. In a nutshell, oil price fluctuations boil down to these key points. 1. Oil prices are influenced by a delicate balance of supply and demand, geopolitical events, and global economic health. 1. Conflicting signals about oil demand arise from the unpredictability of economic forecasts and the ongoing energy transition. 2. The future of oil prices remains uncertain due to these conflicting forces at play. So, the next time you see oil prices taking another twist and turn, remember, it's all part of the complex, ever-evolving narrative of the global oil market.
Are you puzzled by the recent dip in oil prices? You're not alone. Buckle up as we delve into the intriguing world of oil prices and their fluctuations. The story begins with a decrease in oil prices. Brent crude oil futures contract for February delivery slipped 6 cents or 0.08% to $76.55 per barrel. The West Texas Intermediate crude oil futures contract for January delivery in the United States declined by 15 cents, equivalent to 0.21% to $71.43 per barrel. What prompted this early session plummet in the market? The Federal Reserve Bank of New York's manufacturing survey signaled a potential weakness in oil demand. New orders fell for the third consecutive month, which could be a harbinger of weaker oil demand in the coming years. The narrative took another turn on Thursday when U.S. Federal Reserve Chairman Jerome Powell made a statement. He indicated that while the interest rate increases aimed at curbing inflation may have ended, the door remains open for further increases. Later, the dollar fell to a 4-month low following comments from the Fed chairman signaling lower borrowing costs will take place in 2024. This led to a sideways movement in the USD index on Friday. A weaker USD often makes oil prices listed in USD cheaper for foreign investors. In its monthly report, the International Energy Agency announced that world oil consumption will increase by 1.1 million barrels per day by 2024. Although this estimate is 130,000 barrels higher than the previous forecast, it's still less than half the forecast of 2.25 million barrels per day from the Organization of Petroleum Exporting Countries. The week ended on a positive note for the oil market with a lower rig count from energy technology company Baker Hughes. The number of oil and gas rigs, an indicator of future output, decreased by 3 rigs to 623 in the week ending December 15th. So, to summarize, the decrease in oil prices can be attributed to several factors. The Federal Reserve's manufacturing survey indicating a possible decline in oil demand, the dollar hitting a 4-month low, and a decline in the rig count. However, the International Energy Agency's forecast of increased oil consumption by 2024 could be a beacon of hope for the oil market. Thank you for joining us on this journey through the labyrinth of oil prices. Stay tuned for more insightful discussions on the world of finance and investments.